Good evening, everybody. I think it's been a fascinating week or two. Certainly since we last spoke, the markets are really quite busy now. And what we've had is a very strong performance. We're going to set the scene first here. We've had a strong performance from stock indices. Equity markets have been on a strong run higher, as you can see here on the chart. We had this sort of 27% move higher. We've had a 9% rise in 2024. That was before, obviously, today's CPI release. But this just shows you that what we're dealing with here. Stock markets have been ignoring an awful lot of risks out there, particularly higher yields and some very strong US data. So I think now more analysts, investors, and traders are asking quite a big question here: are stock indices due for an April correction? And with what we've seen today and a few other things, we need to consider some of the correction triggers, if you like. So one of the main factors is obviously the pricing in of less Fed easing. As you can see on the chart on the right here, swaps priced in 23 basis points of cuts for July meeting, 50 basis points by November. June is almost being taken off the table. So it looks like the Fed may not be the first to cut. Certainly, we've seen the S&P already, but if we listen to Fed speakers, there is no rush to cut at all. And strong employment and ISM data has added to that view. And it's very difficult for the Fed to ignore this data, particularly ISM and PMI data, which is forward-looking, whereas unemployment is rather backward-looking. But there is no two ways about it. We have stubborn inflation in the US economy, and today's CPI certainly underlined that, moving higher again. This is the third month on the trot. This is becoming a bit of a concern, which is why we saw the big move in the markets today. And we get PPI data. Now, PPI is Producer Price Index. This is factory gate or finished goods data, which is part of the inflationary dynamics as well. So that could actually, with the market so sensitive to inflation data at the moment, impact the markets as well. So what we're looking at as part of these correction triggers is less rate cuts. It equals higher bond yields, which is what we're seeing today. Historically, this is not good for tech stocks, although they've been trying to ignore this recently. And focusing on the fact that there may not be an economic recession, and that better growth will be better for earnings. And so that is why I think the impact so far has been rather muted. Strong economy, good earnings. Why would you want to get out of your favored stocks? And the question is, at what point do interest rates get to, or yields get to, where it tips the balance? And some people are talking about 10-year yields at 4.5%, which is what we're very close to at the moment. 2-year yields at 5%, which is where we're getting close to as well. Is there a tipping level here that actually triggers this bout of profit taking that takes stocks down 5 or 10% rather than just the 1% drop we get every now and again, and then it goes racing back up again? So we're at a bit of a real crisis point here, with the data being strong, and this idea that historically higher yields have not been great for stocks. But let's take a look at the charts, and Richard's here to explain where some of the charts are at the moment. And I think there's a potential bit of a change going on here, Richard.
Yeah, thanks very much, Mo. Good evening, everybody. It does feel that way, to be perfectly honest. Yes, the type of price activity that we've been seeing develop, certainly within the USTech 100 index, and here we've got a daily chart showing price activity for the year. You can see that really since the beginning of March, even though we have made new all-time highs within that type of price activity, that there's a definite slowing in upside momentum here. So in other words, while we did break new highs, we weren't able to sustain that move to the upside, and we've started to see more serious selling pressure beginning to emerge. And with the latest decline in early April, retesting the previous low, it looks as though we're starting to get what's called a potential bearish head and shoulders pattern forming within some of the US indices. Now, this is basically where we have three distinct peaks, with the middle one being higher, which was the March 21st rejection high, marking the head. So we have the left-hand shoulder, the head, and a much smaller limited bounce forming the right-hand shoulder. Now, to complete this type of pattern, we need to see a close below the neckline support, just under the 18,070 area. So if that starts to give way on a closing basis, for me, it would suggest that the risks are beginning to build towards a more extended retracement of the year-to-date strength. And we would then run Fibonacci retracements on the entire year's range so far, and the 38% level stands at 17,579. So that would be the first sort of support point, and that would also mark a potential minimum objective of any sort of reversal pattern. So I think the support levels are going to be very important. The activity that's formed this type of possible sentiment shift is a concern. And if we do start to see further development of the weakness that we've seen so far today, then that may well trigger a deeper retracement. And I think that would likely be seen within the other indices and other global markets as well. So I think certainly correction themes are beginning to materialize from here.
Okay, thank you. I think we've got these correction triggers that we're looking at. I think um, what we can add to that is the earnings. If we look at yearly estimated earnings growth in Q1 2024, what we're beginning to see is that big banks, JP Morgan, Citigroup, all those report on Friday. But the expectations at the moment are somewhere between 4 and 5%, depending on who you talk to at the surveys that we've seen. So I think what we've got here, either we're going to have a disappointment, or because the earnings are the expectations are set fairly low, that we get what we saw in the fourth quarter of 2023, where 1% was expected and we got 8% earnings. I mean, that obviously was a tailwind for stocks. But I think what we need to look at is some of the earnings expectations specifically. So the Magnificent Seven, to me, we're nearer the Magnificent Two because some of the others are dropping off. But their profits are expected to soar across the board. Is there a disappointment there? Possibly. It's very difficult to judge with earnings, but I think you've already realized that we have to listen to what some of those CEOs have to say in and above the actual earnings results. 7 of 11 sectors of the S&P 500 are expected to see growth, as you can see here on the chart on the right. With healthcare, materials, and energy looking to be sort of potential losses there. Are we seeing improving margins? I think that's going to be absolutely crucial to how investors see these individual stocks and how do they deploy their record cash levels. The problem is, a lot of the spare cash, rather than investing into the businesses, goes to shareholders. But shareholders are not going to argue with that, that's for sure, and they like that sort of thing. So equity buybacks still doing their job, although in a longer term macro basis, some of these industries need reinvestment from these companies, and it's not happening because they're spending all their money in paying their investors. But it's hard to fight that. But I think it's still worth considering that there are correction triggers out there that are beginning to impact stocks. And again, Richard, I'm going to pass over to you and ask you to sort of have a look at a few of the other charts here, if you wouldn't mind.
Yeah, no problem. Great, thanks very much, Mo. And again, I think the evidence really coming through from the US 500 index is that we are starting to see this sort of bearish reversal type price activity. It's certainly been a very strong run that we've seen so far in the year. And it's been a very impressive move to the upside. And you can see that the Bollinger Mid Average has held that rally on a very consistent basis. Each setback has found support from it, and we've continued to rally and make new highs. However, that has changed over the last, well, really since the beginning of April, because we've seen the correction developing back from the all-time highs, but that has seen us break and close below the rising mid-average, which is now beginning to roll over. And that currently stands at 5,257. So that is viewed, especially after today's sharp sell-off following the CPI data, that's viewed as the now being quite an important resistance area to the upside. And again, we have this potential reverse head and shoulders top forming, and the potential of it even being completed with today's decline. And again, that would bring in the Fibonacci retracements of the year-to-date's upside move. So just under 5,100 is the first retracement within the S&P 500 index. So the overall risk is still very much for corrective themes after today's move. And certainly while this mid-average resistance remains intact, then the potential and the evidence points to certainly a long overdue correction beginning to occur, because let's face it, it has been a very strong advance within global equities as it stands at the moment. So I'm going to hand back to Mo, who's now going to look at oil.
Yeah, I think there's some other things going on here, and some of these actually relate into the risks with stocks as well. I think geopolitical events are certainly escalating in the Middle East. I think this is a concern. I think the drawing in of Iran and Israel against each other rather than using proxies is really quite worrying, and I think it's something investors should be worried about as well. There's no doubting the rising tensions between Israel and Iran, and that strike in Damascus on Iranian soil, basically being an embassy, is a potential game changer for Iran. Reprisals and retaliations remain to be seen, but the Red Sea issues remain. As you can see here on the chart on the right, oil is still holding some very significant gains. We've seen oil prices up 19% in this year alone, and it's only April. And these are realistically creating what could be very real inflation concerns for central bankers going forwards. Uh, Oil matters, and there's no two ways about the fact that it matters. And headline CPI data is not going to go down with oil staying up here. And the longer it stays up here, I think the bigger the impact is. You're going to see petrol pump prices rise in the US. That could be an election game changer for Biden. We're going to see, people start to sort of adjust their inflation expectations when they're having to pay more for energy bills, and this is very important. And whilst the central banks try and strip out this data because it's volatile, it still matters to the public. So could this start to press on spending? Higher energy costs historically are not good for German exporters either, and we've seen this in the past. So could we start seeing a bit of an underperformance in some of these European equities, particularly the German 40 or something like that? And I think that's again where I want to pull in Richard and maybe have a look at charts, like on the German 40, and see how we're performing there. Because Richard, I don't know if you agree, but things seem to be turning over a bit in the DAX.
Yeah, I mean, very much so, Mo. I mean, I think again, it's the correction themes that are beginning to materialize for global equities. After latest activity, really since April began, we've started to see more pressure beginning to build. And while we haven't got the sort of classic type reversal patterns that maybe we have the potential of within the US indices, certainly we've continued to see deterioration beginning to develop within the Germany 40. For instance, we've seen closes this week below what is still a rising Bollinger mid-average. So we need to see that turn lower. But the fact that we've closed below it is a concern. And unless we start to see a fairly quick and sharp rally back above that average, the risk is that it begins to then turn lower, and that sees a deeper retracement beginning to materialize back towards the 38% level, just under the 18,000 area. So, again, the evidence still is that after what has been a very, very strong advance for the Germany 40, the close below the mid average is a concern, and that may well be just highlighting that the positive steam is beginning to run out of the market at these higher levels, and that some sort of reaction, some sort of correction is due to unwind upside extreme, which potentially for the longer term is a healthy thing to do, but certainly the shorter term risks seem to be towards lower levels and the deeper sell-off beginning to materialize.